If you are a UK tax non-resident, then the only thing that you would be subject to capital gains tax on is the disposal of UK land and property. If you are selling anything else or realising any other capital gains, for example, you were selling a share portfolio or you were liquidating a UK limited company, then there is effectively no capital gains tax, which is great. However, HMRC don't like the idea that you could potentially just leave the UK for 1 year, become non-resident, realise massive gain, and then come back within the scope of UK taxation and not pay any capital gains tax. So as a result, they have something called temporary non-residence rules, which is an anti-avoidance rule to prevent people from purely looking to avoid paying UK taxes. What that means is that if you have been a UK tax resident for at least 4 out of the previous 7 years prior to your departure to the UK, then you have to make sure that you are non-resident for at least 5 whole years. Otherwise, HMRC will consider you a temporary non-resident. If you're considered to be a temporary non-resident whilst you're outside of the UK, then woohoo, no capital gains tax to pay. However, if you then were to return back to the UK within those 5 years, any gains at all that were realised during that period of non-residence that would fall within those rules will come back within the scope of UK taxation. And when I say any gains realised that would fall within those rules, what that means is any kind of gains that you had or any assets that you held at the point of your relocation that you realised gains on would come back within the scope of UK taxation. However, anything that was bought and sold whilst you were a non-resident would fall outside of the scope of those rules. In terms of temporary non-residents, other things to consider in terms of things that could potentially fall back within the scope of UK taxation are taking significant dividend distributions from a limited company. So if, for example, instead of liquidating the limited company, you decided to take your money by means of a dividend and that money was disregarded, thus not creating a tax liability in the UK, that would fall back within the scope of taxation if you're temporary non-residents when you return to the UK. And similarly, pension distributions, other than a regular annuity, if you were taking a massive drawdown when non-resident, if you're considered temporary non-resident, that would fall back within the scope of UK taxation. If any of that is confusing to you and you want to have some help or support with that, then please do let us know.